Hello everyone. Today we're going to talk about something that might be on the minds of many NRIs out there. Returning to India after retirement. Have you also been thinking about it? Well, let's take a closer look at some of the key questions and answers to help you make a more informed decision. A survey states that close to 60% of NRIs want to return to India post-retirement. First off, do you ever wonder why so many NRIs are considering coming back to India after retirement? Well, as our survey suggests, it's often due to a combination of factors. Could be the tough living conditions abroad, the impact of COVID-19, personal preferences, or the promising opportunities in India's resilient economy. But here's the real deal. Are you seriously thinking about making the move? It's not as simple as booking a flight ticket, right? You've got to take into account emotional, financial, social, and personal factors. So let's break it down for you. Emotions often play a huge role in such decisions. Do you ever find yourself daydreaming about the warmth of Indian traditions, the nostalgia of your hometown, and being closer to your family and friends? Those feelings might be the first step towards your decision making. Financially speaking, have you considered your retirement savings and how they will fare in India? The cost of living, healthcare, and inflation can be very different here. You've got to crunch those numbers. Question number 1. Are you prepared for retirement and a potential move to India? It's a big step and you've got to be ready both mentally and financially. Have you thought about it properly? Now here's a crucial one. Do you know your residency status? That can affect your taxes and legalities. So have you figured out whether you'll be an NRI or an Indian resident? Moving on to question number 3. What's your retirement plan? Do you have a clear picture of where you want to live, how you'll spend your time, and how you'll manage your finances? It's time to map it out. Speaking of finances, have you completed your responsibilities, especially any financial commitments or obligations abroad? It is vital to tie up those loose ends before making the move. Now let's talk about pre-retirement tasks. Have you considered things like healthcare, insurance, and investments? It's time to make sure everything is in order for your golden years. Question number 6. Taxation on your overseas assets. Do you know how your overseas assets will be taxed in India? It can be a complex topic, so it's worth being informed. The classic dilemma, interest rates and inflation. Do you have a plan to combat the eroding power of inflation on your savings? It's something to ponder about. Last but not the least, stay away from sharks. No, not the ones in the ocean, but the financial ones. Be cautious about investment schemes that promise the moon. It's essential to protect your hard-earned money. If you're a first-generation NRI, the idea of returning to India, it's not a walk in the park, but it's certainly doable. Let's get into it by asking some key questions and, of course, providing some answers to help you navigate this journey. First things first, have you tied up all your financial requirements for your post-retirement life? Are there any loose ends, both financial or professional, that you may need to address before making the move back to India? Now here's a big one. Is your plan to move to India fully endorsed by your family? We're talking about your spouse and your children. Disagreements among family members can often be a stumbling block when it comes to relocation plans. Now let's talk money. Have you accumulated an adequate corpus to meet your post-retirement needs? After all, the comfort of your life in India largely depends on this. It's time to crunch those numbers and make sure you're financially prepared. There are multiple financial calculators available to find out the retirement corpus that you need. Use these calculators to find out the corpus you need. So folks, these are some essential questions to ponder over if you're a first-generation NRI thinking about returning to India. It's all about ensuring that you've got your bases covered from finances all the way to family support. Now we're diving into the finer details of something that's crucial if you're planning to relocate to India: your residency status. It can get a bit tricky with different guidelines from FEMA and income tax rules. So let's ask some questions and untangle this web, shall we? First up, when you relocate to India, your residency status changes to resident as per FEMA guidelines. But what's the situation when it comes to income tax rules? Well, according to the Income Tax Department, when you return to India for good, your status changes from non-resident to resident, but not ordinarily resident, RNOR. It's kind of like a transition phase to help you get organized before you fully become a resident. And this status is super important because it determines the taxability of your income. To be classified as RNOR, you need to meet one of the two conditions. Either you should have been an NRI for 9 out of 10 previous financial years, or your total stay in India should be 729 days or less in the previous 7 financial years. That's a bit of a puzzle, right? Your status would be RNOR by default in the first 2 to 3 years from the time you relocate to India. It depends on the days you've spent in India in the previous financial years and the date of your relocation. But here's a cool perk. During the RNOR period of 3 years, you'll be treated like an NRI and you can move your overseas assets to India without any tax consequences. Now, who doesn't love a good tax break, right? Now, here's a little twist. The only difference between NRI and RNOR is that income from an overseas business set up from India is taxable for RNOR, whether received or allowed to accrue. Now, this income is exempt in the case of an NRI. After the RNOR status period, you'll officially become a resident Indian. So it's kind of like a grace period before diving fully into the resident status. Let's look at an example. Imagine Navneet, who's a software engineer who's been working in the US for over 20 years, relocates to India on 5th September 2022. He's a resident with effect from the date under FEMA, but he has spent 208 days in India. Even though he's a resident for FY23, he's given the RNOR status because he was an NRI in 9 of the previous financial years. Now let's say his total stay in previous years in India adds up to 625 days till March 23. Then the total number of days in India in the previous 7 years up to 2023-24 would be 890 days, making him a resident in 24-25. So there you have it. Your residency status in India can be a bit of a puzzle, but with these questions answered, you can navigate it like a pro. Let's delve into an essential topic that concerns your retirement planning, whether you're settling down in your host country or planning to return to India for good. There are some crucial steps to consider, especially if you're making the move back home. So let's ask some questions and uncover the answers. First of all, financial independence after retirement. It's a big deal, right? Have you accumulated the requisite corpus for a comfortable retirement? It's time to double check, considering the current inflation rate and of course interest rates. Now, if you were planning to work after retirement, you have analyzed the changes in your finances due to the move to India. It's crucial to understand how your funds flow might be affected. And if you're considering professional opportunities in India, have you explored all the avenues that match your skills and capabilities? The job market in India can be quite diverse, so make sure you're not missing out on any potential employment options. If your plan is to set up a business enterprise in India, have you conducted a thorough analysis of the business landscape here? Consider factors like resource availability, technical support, local restrictions, marketing strategies, and financial planning well in advance to avoid any potential roadblocks. Moving on, where are you planning to settle down in India? Your choice of location can impact your overall plan, so give this some serious thought. What if you don't have a home in your desired Indian city? Well, it's time to start house hunting and finalizing the purchase from your accumulated corpus. You could also explore selling a property that you own elsewhere to fund your new home in India. Continuing our journey through the intricacies of relocating to India, especially when your heart is set on it, but life's responsibilities seem to pull you in different directions. These questions are crucial and the answers might help you understand why some NRIs defer their plan to return to India. Here's a common scenario. Do you have a son or daughter in college or perhaps pursuing higher education? Well, perhaps they're a year or two away from completing their course. Have you set aside enough funds to support their education or made sure that the necessary finances are in place? But what if you're planning to relocate before they finish their education? Have you made the necessary arrangements for their stay and all their needs till they complete their studies after you leave the host country? And let's not forget weddings. If your children's weddings are on the horizon, have you decided whether they'll take place in the host country or back home in India? Plus, have you figured out where the finances for these weddings will come from? It's quite common for parents to be very concerned about their children's education or wedding than their own retirement needs. But it's essential to ensure you don't overstretch yourself or dip into your retirement corpus to fund these events, as it could impact your post-retirement plan and income. And let's not forget about the professional and social responsibilities that you may have in your host country. It's crucial to make a proper succession plan for these roles to ensure that you do not leave any unfinished business behind. So first, start looking at all the stuff you've accumulated over the years. It's time for some decluttering. Why? Because the cost of transporting unwanted items can be more than the price of buying new ones in India. Plus, some things, especially electronics, might be outdated or not usable in India. And what's the best way to get rid of your unwanted items? You can either spread the word among your friends and family or have a good old-fashioned garage sale. One man's trash could be another man's treasure, right? Next, let's talk about finances. It's essential to clear all your outstanding balances on your overseas credit cards well before your planned departure. Why, you ask? Because those dues can quickly multiply due to high charges. Nobody wants their name blacklisted or face difficulties returning to that country later, right? The same goes for any outstanding loans. Now, what about insurance? Check whether your insurance cover from the host country will provide the necessary coverage back in India. It might be a yes or no situation. If it's a no, be prepared to purchase new policies in India that fit your needs, especially health and life insurance. It's crucial to have this coverage from day one of your relocation to protect yourself in case of any unfortunate incidents. Before you go, settle all your subscription dues and utility bills. Leave a clean slate behind. It's also a good idea to register a forwarding address in India with the appropriate authorities so you don't miss out on any important communication. And here's a tip. Retain your mobile number from the host country with a basic plan. Your mobile number might be linked to banks, investments, securities, etc. And you can switch to an Indian number, but make sure you've sorted out all the necessary arrangements before doing so. The next logical step is to dive into the complex world of overseas assets and how they can affect your plans when relocating to India. It's not as simple as booking a movie ticket, but with these questions and answers, you'll have a clearer picture of what to expect. So what happens to your overseas assets, income and taxation when you're planning to relocate to India? Well, it's a bit of a maze and it varies from country to country. Let's take an example of an NRI from the US. In the US, investments in 401k accounts provide a tax advantage while you're there. But any withdrawal before 59.5 years of age is considered income and there's a 10% penalty. For instance, a $10,000 withdrawal could cost as much as $3,200 in taxes and penalties if you're in the 22% tax bracket. But here's the thing. Similar scenarios can unfold in other countries when it comes to withdrawal or repatriation to another country. It's essential to study these rules carefully with the help of a professional to make sure you're not missing out on the real benefits. Now, before your departure, make sure to complete all tax-related issues in your host country. Submit your tax returns and settle your tax dues well in advance so your relocation plan goes off without a hitch. Under FEMA provisions, as an NRI returning to India, you can continue to hold on to overseas assets even after becoming a full-fledged resident without requiring any permission from the RBI. But if you plan to liquidate them, do it before you lose your RNOR status to avoid taxation. Keep in mind that you will need to report details of assets and securities held outside India and the income received from them in your income tax returns after you lose your RNOR status. Foreign currency held by you on relocation can be credited to a resident foreign currency account or your NRE account. Now, as an NRI or RNOR, you can sell your overseas assets, receive proceeds in your overseas account, and transfer the same to your Indian NRE or NRO account without any tax implications. Once you're in India, the first order of business is to get or update your PAN and Aadhaar card. These are essential for you to start your financial transactions in India and provide you with an address proof. Make sure all the data entries like your name, spelling, date of birth, phone number, etc., they're all correct to ease your financial transactions in India. During your RNOR status, there are some tax benefits as well. You don't have to pay tax on income or even on capital gains from the sale of overseas assets. Pension received from your overseas pension scheme account is also tax-free. Interest received from NRE, RFC and foreign currency non-resident account or FCNR is also not taxable. But remember, some changes need to happen when you lose your RNOR status. Your NRO account should be converted to a resident account and TDS is applicable on the interest until the date of conversion. For your NRE accounts, funds can be transferred to RFC or a resident account, and interest becomes taxable after you lose your RNOR status. Your FCNR account can continue until the maturity of the deposit, after which it can be transferred to RFC or a resident account, and the interest becomes taxable after your RNOR status. Your overseas assets and income are no small matter when planning your move to India. Now, these questions and answers should help you navigate this complex terrain. We should definitely be looking into something that's crucial for your retirement plans: the ever-changing financial landscape. Your retirement plan might have been set up some time ago based on certain assumptions on interest rates, inflation, so on and so forth in your host country. But when you're actually gearing up for retirement and relocating to India, things could look quite different. So let's dive into this and find some answers. Let's start with talking about inflation. The effect of inflation might have been different in your host country, and your retirement planning was based on those assumptions. So you need to revisit your retirement planning, rework your corpus, portfolio, as well as annuity retirements to make it more meaningful for your retirement in India. Now let's address a significant issue you might face: the continuous downward revision of interest rates. This can bring in two problems to your doorstep. First, your accumulated corpus may fall short of your original estimate, making your retirement nest egg smaller than expected. Number two, the corpus needed for post-retirement annuity might turn out to be higher, as the realized interest is lower than the assumed interest. Since the falling interest rates affected fixed income securities like fixed deposits, bonds, and other debt securities, you might be wondering how to offset this impact. Well, a careful study and diversification into equities at the appropriate time can help you weather the interest rate storm to some extent. Here's a crucial piece of advice: rework your plan and explore smart investment avenues to provide you with stable, regular income even during a falling interest rate regime. Did you know that investment options like mutual funds offer hybrid schemes which invest the funds in the combination of equity as well as debt? Now, this category of funds can help you beat inflation, generate regular cash flow, and reduce tax outgo compared to the interest that you earn by fixed deposits. You can consider this investment as long-term investment option and opt for a systematic withdrawal plan or an SWP. I'm reconfirming again, hybrid funds are meant for the long-term investor, and these carry market volatility since it would have allocation to equity as well. Your retirement planning might need a bit of a makeover to fit the changing financial landscape. These questions and answers should help you adapt and make your retirement plan more robust. You might have noticed that your relocation plan is getting quite a bit of attention from various quarters: friends, relatives, bank employees, and even house brokers. Let's tackle this and find some answers to the barrage of advice and attention that you might get. Here's the thing: when you're planning a big move, you'll be swarmed with advice on investments, business ventures, and much more. Everyone has a great opportunity to pitch, right? But be cautious. Not all advice is created equal, and dividing into uncharted waters can damage your funds irreparably. While you can be hospitable in entertaining these well-wishers, it's crucial to stay away from unsolicited advice. No fear, no favor, just good judgment to avoid bad investments. In situations like this, it's wise to seek out professionals who can provide impartial advice. Whether it's about your residential status, taxation, or investment strategies, these experts can guide you to make the right decisions and protect yourself from unexpected shocks. Your relocation plan might be the talk of the town, but not all advice is golden. These questions and answers should help you navigate the sea of suggestions and find the right guidance when you need it. As you gear up for your big relocation to India after decades of staying in your host country, there are a few minor issues you should be prepared for. With careful planning and timely professional advice, you can just breeze through these hurdles and make your retirement stay in India pleasant as well as enjoyable. Finance professionals can do wonders for you. They can help you identify the benefits of the Double Taxation Avoidance Agreement (DTAA) between your host country and India. This agreement can potentially lead to significant tax savings and help you navigate the complex world of international taxation. Seeking professional help in these complicated matters can actually relieve you from possible stress of figuring it out all on your own. So as you prepare to make the big move, remember that these professionals are there to guide you and ensure your retirement in India is as smooth and as enjoyable as possible.